Welcome students to Chapter 1, Video 10. This video will discuss the different issue methods in the UK. So when we're talking about issue methods, we're talking about primary markets, okay? And how are we going to issue for the first time shares or debt instruments. And this focuses specifically on the UK. So last year you would have covered the JSE requirements, and this year we're going to look at the United Kingdom requirements. So whenever a company wants to list on the stock exchange, and in particular we are talking about the London Stock Exchange, it is regulated by the FCA and the UK Listings Authority. Okay, there is a monitoring of market disclosures, which means that certain disclosures need to be met. And when you're studying accounting or financial accounting, you'll be doing IFRS, and those are the standards and disclosures that need to be done. There's a review of the prospectus and other documentation, and there's a UK listing regime. So when applying for a listing, a company needs to have a trading record. Okay, so when they're talking about trading record, we're saying that they need to have financial statements for at least 3 years. Okay, they need to make X amount of profit, certain amount of profit, and they need to have a sponsor. And that's a very important thing, sponsor, right? And a sponsor is something like an investment bank, a stockbroker, or a law firm, and they will guide the entire process. Another word for a stockbroker is the underwriter. There's a minimum number of shares that needs to be distributed to the public. Okay, so we don't want we don't want them to list a company and only sell 5% of the shares. There's a minimum number of shares that needs to be sold in the public, and that amount is 25%. So at least 25% of the company needs to be sold. Prospectus. So the company and its advertisers must publish a prospectus. So a prospectus is basically like a brochure. And that brochure will give us a story about the company, give its financial statements, show where it's heading and what type of company it is, what it does, etc., etc. And there's continuous disclosure requirements. So once the company shares have been listed, they must still fulfill a number of obligations on a continuing basis. Okay, so an example of this, every year they need to be audited by independent auditors, external independent auditors. They need to produce half-year and full-year financial statements within a certain time frame. They must notify the market of price-sensitive information, and they need to comply with the IFRS rules and regulations and standards. So what is the actual procedure for a public issue of shares? So number one, circulated prospectus, and that's just going to tell everyone, okay, we're this company, okay, we're X company, and this is what we do, how we do it, how much we've made, and what we want to do in the future. And from there will be an offer for subscription, and that basically means that the shares are offered directly to the public, not underwritten by any investor, bank, or other sponsor. Okay, so that's direct to the public, no middleman. Offer for sale is directly or within another underwriter to specified price. So the company sells to the sponsor, and that sponsor sells to the public. And anything that's not sold will be bought by the sponsor. The sponsor would buy anything that's not sold. So they underwrite the whole issuing of the shares. In case of an oversubscription, and that means that if the company offers 10,000 shares and you get an offer to buy 20,000, so then the company will, then the house will decide how that is going to be allocated. It could be on a first come first serve, it could be on a pro rata basis, it just would depend on the specific company. Invitation to tender, offer to tender, is the issuing house sets a minimum price. So they'll set a price of say 5 Rand per share, and then they'll ask the public to bid. And the public might bid 5 Rand 50 because they think it's a good company. And it can't go lower than the minimum. Private placement is a sale direct to the investment house or other sponsors. And normally this will happen if they already have a large number of investors. So an example of this is also if they're moving from an alternative investment market to the London Stock Exchange main market. An introduction is typically employed when a company already has a broad spread of shareholders. So that actually is what the private. No. So introduction is if it's going from one market to another. Okay. The next type of issuing in the primary market we're going to talk about is called government bonds, and you guys should really know what a government bond is. So in the UK, they issue government bonds by auction. Okay, so they accept all bids in above a minimum. They rank it from high to low, and eventually may be permitted to make non-competitive bids. So they give individuals a better chance to buy those government bonds. Any unsold bonds will be retained by the issuing authority and may be offered for resale at a later date. Okay. So an example of this is that, say for example, US Treasury bonds are sold by the government by auction in the primary market. So investors may play competitive or non-competitive bid with a minimum purchase amount of $1,000. And an investor may bid non-competitively for up to $5 million in any security. So you can read through page 41 as well, and it will give you a few more examples. Okay. And then the last issuing of the primary markets would be the Euro bonds. So as we discussed 2 weeks ago, a Euro bond is an international bond issued in markets outside the domestic market. So when we're doing a Euro bond, there's a lead manager and syndicate, and that the lead manager is usually a financial institution, which could be an investment bank, and they do take responsibility for the entire process. The syndicate is a group of investment banks that will market, sell, and underwrite the issue. Then we have the underwriters, advisors, trustees, and paying agents. And generally, the underwriter will purchase any unsold Eurobonds at a certain price, and they'll be paid a commission for doing such, and they will take the risk. Legal advisors are responsible for conducting due diligence and has to make sure that everything is fine. Okay, that the process and everything is correct and valid. Trustees are acting on behalf of the investors and that they ensure that the issuer adheres to conditions set out in the bond. The paying agent is responsible for receiving coupon payments from the issuer and distributing this income to the bondholders. And we have two types of issuance methods. The first one is a bought offer, where the lead manager purchases the whole issue and sells on to its own clients. And a fixed price offer, where the lead manager distributes to the syndicate. And that brings us to the end of this video. Thank you.